I want to get back to your calls, but we do have some breaking news in the BNN newsroom out of the United States. Reuters is reporting that President Trump's Strategic and Policy Forum has been disbanded. Now, they're quoting an unnamed source on that, but of course, we know a lot of people have been fleeing. Captains of industry in the States, his manufacturing council as well. So it would appear that President Trump, who definitely had the backing, it seemed, of a lot of corporate leaders for all the changes he wanted to make, is having a bit of a tough time in courting these people now.
I think he's getting himself into a tough spot because he's really trumpeted all of these various councils and how he's going to take counsel from different people, and it sounds to me like he's trying to get in front of more people defecting from various councils that he's involved in.
Do you have to worry about his economic strategy? We know the big run-up in the U.S. equities is the fact that Donald Trump was going to push forward all these policies that were going to be good for the Wall Street banks, were going to be good for the U.S. economy. He seems to be getting mired in other issues. We're not even anywhere close to any kind of Wall Street reform.
I think it's pretty clear that the economy was improving before he came, as we know. And markets were telegraphing stronger markets as early as April, May, June last year when it didn't look like he was going to win. There was a clear run-up after he was elected, but I would say that premium that was built in for all of those expectations largely has come out, but the economy's kept getting better. So I don't think that there's a lot of expectation right now in the market around tax reform and infrastructure. You know, they do have an opportunity in those areas, but he's really having a hard time getting anything done.
All right, we do have now a tweet from President Trump as well. He says, rather than putting pressure on the business people of the Manufacturing Council and the Strategy and Policy Forums, I am ending both of them. Thank you all. So that's the official statement now from the President of the United States. Let's get back to the calls and back to the stocks. We got Joe in Montreal calling in. What's your question for David?
Hi, Rich. Stock showdown number round 2. TD versus National. I'm retired and I have about between 40 and 50% in 3 Canadian banks, those 2 plus the Royal. And I know you're saying about, it's been a bull market for over the last several years. And I'm wondering about rebalancing, and I'm thinking since TD has its foot in the U.S., should I start putting some of those gains I've had in National Bank over to TD? And I want your opinion on that strategy. Thank you. I'll hang up and listen.
Thanks, Joe.
Joe, I think that's a great question. And I think there's a number of points that we want to talk about here. But first of all, if you want to make a switch from one Canadian bank to another Canadian bank, I do think that TD makes more sense than National. Right? National has a little bit more energy exposure, of course, more domestic exposure. TD has more U.S. exposure. I wouldn't try to dissuade you from actually buying a U.S. bank or even a global bank like Citigroup or JP Morgan or Bank of America. I would rather you did that than buy another Canadian bank, right? Especially if you've got 30% of your holdings in Canadian banks. I think there's a number of potential headwinds for the Canadian economy. Energy, I think, is going to continue to be a headwind. Low cost finding in the U.S. is having an impact. I think it's possible the real estate market is going to continue to see some headwinds. I read a statistic last week. 3% of our GDP is just transaction costs for the housing market. 8% of our GDP is the housing market itself.
And we're a big cool down in the Southern Ontario market, which is the largest market in the country.
Well, we have been building homes at a more rapid pace per population than they were at the peak in the U.S. housing market. And there's a lot of speculation in that market. So that could cool down. And the last thing is the auto industry is selling more cars per population than the U.S. was at the peak of the housing boom in 2008. And that's because people feel wealthy. So I think that there's risk to the Canadian economy. And I think a rising dollar and rising rates don't help things. So I'd rather you buy a U.S. bank, but if you're going to buy one beyond Royal, it would be TD.
I find the rising dollar scenario interesting, too, because we know that a lot of people have been trying to get out of Canada, diversify a bit, invest in U.S. stocks. Then the loonie gets within spitting distance of 80 cents. But over those 3 months that we're going to start getting bank earnings next week, the loonies run up 10%. Could that hit some of the Canadian banks that are more U.S. focused?
It certainly can in the very short run. And look, in the last 5 years, there have been several sharp rallies in the Canadian dollar. Every one of them has run out of gas. I think that there are things that could create some headwinds for the Canadian dollar. I would use the dollar strength to buy some U.S. dollar assets.
All right, we're going to be back after this short break. We're going to take a look at some of the past picks. That's coming up next.